Good morning, this is Ray Attrell from National Australia Bank with this morning's market update. Well, we've ended the night with US stocks not that changed really, following a positive day for European stocks, but we have got bond yields lower across the board and also a stronger US dollar. As far as the budget is concerned, there's been very little offshore market reaction, and indeed we wouldn't expect too much follow through as far as currencies, equities and bonds today. The main price action overnight has actually come in the euro-dollar exchange rate, which has continued to fall down to about the 137 level against the US dollar. And that follows a Newswire report quoting sources from the German Bundesbank suggesting that they are amenable to both cutting interest rates potentially into negative territory and also some form of quantitative easing potentially involving the purchase of bank assets. That served to send the euro lower and also has put bond yields under downward pressure both in Europe and in the United States. The Australian dollar did actually rally from about 93.30, which is where we left off in Australia yesterday, up to a high of 93.80, and that was in the aftermath of the budget, though in truth a lot of that moves followed weakness in the US dollar that came following US retail sales that reported much weaker than expected headline numbers, just 0.1% against 0.4% expected, with all of the core readings also weaker than expected. However, on inspection and realisation that the previous month's numbers had been revised upwards, there is a suspicion that seasonal adjustment problems around Easter may have explained this volatility, and in fact perhaps the numbers aren't quite as weak as the headlines would suggest. We also had a pretty strong National Federation of Small Business survey. That rose more than expected, indeed to a post-GFC high, considering that both capital expenditure and labour hiring plans are very dependent on the SME sector. That was a very encouraging move. So we did see some reversal of the initial knee-jerk reactions to that weak retail sales report. As far as the budget is concerned, the broad contours of the budget were very much as has been effectively leaked to the media in the lead up to that budget. So as far as the current year is concerned, the government's now projecting an underlying cash deficit of just shy of $50 billion, and that reduces to about $30 billion in the new fiscal year that will begin in July. Our NAB's economists estimate that there will be a sort of structural drag on the economy of about 0.5% of GDP from this implied fiscal tightening. Whether or not that's going to have a significant negative impact on the economy, we're sceptical. We do think that growth can withstand the impact of tax rises basically, and also the increase in petrol duties and the cuts in government spending, but we will be watching upcoming readings on both consumer confidence and business confidence with more than the usual interest. So as I say, there's plenty of time to run through the details of the budget today, but say not a lot of follow-through market reaction is expected. We actually got a pretty blank canvas today as far as data and events is concerned. Offshore tonight we're going to get the UK unemployment numbers and also the Bank of England's quarterly inflation report. Well, the US just has producer prices, which will be far less important for markets, and tomorrow's consumer price inflation report. This is Ray Attrell wishing you a good day ahead.